a single invoice for $179.84. That invoice ended up on a lender's desk, but not for $179. It was on the desk for $9,271.25. Same invoice, 50 times the value. Multiply that trick by tens of thousands of invoices, and you get a $2.3 billion hole that quietly opened up inside one of America's largest auto parts companies. Nobody saw it until everybody did. Most people have never heard of First brands, but you've probably bought from them. Windshield wipers, spark plugs, brake pads, oil filters, headlights, brands like Trico, Champion, Ray Bestos, Autolite, Fran. If you've changed a wiper blade in the last decade, there is a decent chance it had a First brand's part number on the box. The company was built by a guy named Patrick James, founded in 2013, headquartered in Cleveland. By 2025, it employed roughly 26,000 people across about 40 manufacturing plants worldwide. This was, on paper, an American success story, a boring, profitable, dominant supplier of stuff people forget exists until their car won't start. So here's the mainstream story. Auto parts company gets too aggressive with acquisitions. Tariffs hit, interest rates bite, cash flow gets squeezed, files for Chapter 11 in September 2025. Sad and standard. Move on. The story is wrong, because at the moment First Brands filed for bankruptcy. The company had more than $9 billion in liabilities and $12 million in its corporate bank accounts. 12 million. That's a rounding error for a company this size. That's what a regional Toyota dealership keeps on hand. How does a company with 26,000 employees and over $9 billion in debt end up with $12 million in cash? The official answer is tariffs and macro headwinds. That's the version First Brands founder pushed in court papers. The firm's providing his off-balance sheet financing engaged in predatory practices, and that the company was undone by external forces. The real answer involves fake invoices, double pledged collateral, a slush fund called Bowery Finance II, a personal chef on a $500,000 contract, and a federal indictment with maximum sentence of life in prison. This isn't a bankruptcy story. This is something else entirely. Let's start with what was actually on First Brands' box and what wasn't. According to court filings, when First Brands collapsed, it disclosed the $2.3 billion in unpaid balances on third-party factoring liabilities, plus another $800 million in unsecured supply chain financing liabilities. If those words mean nothing to you, here's the translation. When a company sells stuff to a big customer like Walmart or AutoZone, it doesn't get paid for 60 or 90 days. So instead of waiting, the company sells the unpaid invoice to a finance firm at a discount. The finance firm gives them cash today. The finance firm collects from Walmart later. This is called factoring. It's normal. Every Fortune 500 supplier does it. The fraud isn't in the factoring. The fraud is in the invoices. Court filings based on a forensic audit by Alvarez and Marsal. The restructuring firm now running the company cite a single sales invoice that started at $179.84. The version submitted on the lender is $9,271.25. Same invoice, same customer, 50 times the value. And that wasn't a one-off. The complaint says invoices were routinely inflated by 10 times or more, some by 50 times. And here's where it gets darker. According to the federal indictment unsealed January 29, 2026, third-party lenders ended up holding approximately $2.7 billion in what prosecutors literally call fake accounts receivables. That's not exaggerated. That's not inflated. Those receivables represent customer orders that were essentially invented. The customers either didn't owe what the invoices said or didn't owe anything at all. Where did the money go? Most of it ran through an entity called Bowery Finance II. Bowery Finance II was controlled by Patrick James. It wasn't disclosed to most lenders. And from 2022 to 2025, according to the November 2025 lawsuit filed by First Brands' new restructuring management, approximately $12 billion flowed through this single off-balance sheet vehicle. $12 billion through one entity that barely existed on paper. Of that flow, the lawsuit alleges that at least $700 million was diverted directly to Patrick James and affiliated parties between 2018 and 2025. The bulk of those transfers happened between 2023 and 2025, exactly the period when the company was telling lenders everything was fine. Here's the part that should stop you cold. In 2023, lenders started asking pointed questions. Some of them wanted to talk to lower-level employees at First Brands directly to verify the underlying invoices they were funding. According to the federal indictment, Patrick James responded by issuing an internal directive that emails from those lenders be, quote, restricted to an inner circle of First Brands executives, so that no low-level employee would inadvertently supply accurate information to an inquiring lender. Read that again. He gave a written instruction not to let his own employees tell the truth to the people lending them money. Then in July 2025, 2 months before the bankruptcy, Patrick James personally directed the senior executive to tell prospective new lenders that First Brands had no off-balance sheet financing involving special purpose entities. None or related party relationships were fully disclosed. In reality, the company had roughly $2 billion in undisclosed off-balance sheet debt through entities he controlled. He wasn't hiding it from regulators. He was hiding it from the lenders he was actively borrowing from in real time while they were doing their due diligence on him. So who got hit? UBS disclosed more than $500 million in exposure across its O'Connor hedge fund unit and its hedge fund solutions platform. Jefferies disclosed $715 million through Point Bonita Capital, its private credit fund that specifically invests in invoice receivables. Onset Financial, and Utah-based lender, said it had built up roughly $1.9 billion of exposure to First Brands inventory-backed debt. A joint venture between Norin Shuken Bank and Mitsui of Japan said it was exposed to $1.75 billion in trade financing. A trade finance firm called Katsumi Global said it was owed $1.7 billion in unpaid receivables. Millennium Management, a $79 billion hedge fund, took $100 million write-down. Add up the disclosed exposures, and you're already past $5 billion before you count CIT, South Stake Bank, Nomura, Apex Credit Partners, Rainstone, and the dozens of small funds that bought slices of First Brands paper through CLOs and asset-backed deals. And while all of this was happening, while invoices were being inflated by 50 times, while billions were being routed through undisclosed shell entities, while sophisticated banks were getting played, Patrick James was, according to November lawsuit, paying himself enough to maintain 7 homes and 17 cars, $3 million on the rent of a New York City townhouse, $500,000 on a personal chef, $150,000 on a celebrity personal trainer, $8 million on his son-in-law's wellness company. This wasn't a CEO who lost control of his finances. This was, according to federal prosecutors and Internal Revenue Service agents' exact words, a Ponzi scheme. Just a quick break. If you've made it this far, you're the kind of person who reads court filings for fun. So is this newsletter. This week I broke down the 4 debt layers, $11 billion total, $5.4 billion of it hidden, and walked exactly which lenders saw which slice. Footnotebrief.com. Link in description, free. Here's the part nobody on YouTube is telling you, and the part that actually matters. The big banks that lend to First Brands thought they were lending to a company with about 5 times leverage. That's high, but normal for an aggressively acquisitive private equity-backed business. When the dust settled, actual leverage was closer to 20 times. That's not a fraud detection failure, that's a financial system failure. Because here's the structural problem. Off-balance sheet supply chain financing, factoring, reverse factoring, receivables securitization sits in a regulatory gray zone. It often doesn't show up cleanly in 10K filings. It doesn't always count towards leverage governance. It's reported when it's reported, in footnotes, in vague language, sometimes only as aggregate supplier finance program obligations. This is the same structure that blew up Greensill Capital in 2021. Greensill was a UK-Australian supply chain finance firm that bundled trade receivables into investment funds, sold them to insurance companies and asset managers as safe yield, and ultimately collapsed in a tangle of fraud allegations and undisclosed concentration risk. The collapse helped contribute to the eventual sale of Credit Suisse. One of the firm's main backers, a Swiss law firm called LaLive, which actually worked on the Greensill recovery, has explicitly said First Brands' funding model is reminiscent amount of Greensills, different decades, different country, different industry, same plumbing, same blind spot, and same playbook. And it's not just one bad apple. On November 7th, 2025, the Federal Reserve issued its semi-annual financial stability report. In that report, it explicitly cited the bankruptcy of an auto parts supplier, that's First Brands, as an example of, quote, risks of an opaque off-balance sheet funding, potentially amplifying spillovers to banks and non-banks. What does that translate to? The Federal Reserve, the institution responsible for the stability of the entire US financial system, named this specific bankruptcy as a systematic warning sign. Now zoom out. The US private credit market, the same market UBS, Jefferies, Apollo, and Millennium were all swimming in to hold the First Brands paper, has grown to roughly $2 trillion in assets. That's larger than the US junk bond market. And as of January 2026, Fitch Ratings reported the trailing 12 months default rate in private credit at 5.8%, the highest level since they started tracking it. JP Morgan CEO Jamie Dimon's reaction to First Brands and the related tricolor bankruptcy was 4 words. When you see one cockroach, there are probably more. First Brands isn't a fraud story. It's the first really visible crack in a financial system that learned to grow itself in places nobody is required to look. So here's where we are. Patrick James and his brother Edward were indicted on 9 federal counts: bank fraud, wire fraud, money laundering conspiracy, and operate in a continuing financial crimes enterprise. The top charge carries a maximum sentence of life in prison. His legal team says he's presumed innocent and denies the charges. That's true, he hasn't been convicted. The case will play out. But the bigger story doesn't depend on the outcome of his trial. The bigger story is that a company with $9 billion in liabilities, 26,000 employees, and a multi-decade business operating in plain sight, inside the largest banks of Wall Street and inside private credit funds managing tens of billions of dollars. That company was running with $2 billion of debt that wasn't on its balance sheet, and nobody noticed until cash ran out. If that's true for one auto parts company, it's true for others. Here's the question I want you to sit with. When the next First Brands shows up, and it will, should the regulators have caught it, or should the lenders? Because right now, neither of them did. Now look, this is the kind of story I actually think matters in finance. Not the personalities, not the ridiculous rich guy details, but the structural question. Why did a $3 trillion private credit market grow up without a 10K? And what changes from here? If that's the kind of thing you want in your inbox every Tuesday and Thursday, that's what Footnote Brief is. The link is in description and pinned at the top of the comments. The newsletter goes deeper than the video. Every issue is the extended written version with the actual citations from the actual filings. Free, no nonsense. If you want more stories where the numbers tell a different story than the headlines, subscribe. The footnote always tells you more than the headline. You just have to know where to look.